In recent years, the rapid growth of tech companies has led to significant wealth accumulation. And this has prompted governments worldwide to enact stringent tax laws to ensure that these tech companies contribute their fair share of taxes. These regulations aim to uphold the principles of fiscal responsibility and equity within society, and they have reshaped the landscape of the digital economy. In our last video, we discussed the implications of digital taxation regulations in Nigeria for multinational tech companies like Google, Amazon, and Facebook. And we emphasized the need for compliance with the company's Income Tax Significant Economic Presence Order 2020. In this video, we will explore the global challenges faced by tech giants in navigating these regulations and the innovative strategies they have employed to ensure compliance. Hi, my name is Olatunji. I am the founder and CEO of Taxmobile.Online. Welcome to my YouTube channel, A Stitch in Tax Saves Cash. This channel is dedicated to helping you stay on top of your taxes. We will provide you with tips and strategies to help you keep more money in your pockets and minimize your tax liability while you stay in compliance with tax laws. So, if you want to start taking control of your finances from today, hit the subscribe button below and click the notification bells to stay updated on our latest videos. Lessons from global markets. Case study 1. Google in France. In 2019, France implemented a digital service tax to tax the revenue generated by large tech companies like Google from digital services they provide to French users. This tax was set at 3% and it applied to companies with over 750 million euros in global revenue and over 25 million euros in French revenue. With Google's significant operations in France, it fell under the purview of this tax. Google expressed concern about double taxation and the impact on its business operations. This illustrates the complexities and controversies surrounding digital taxation, especially when multinational tech companies operate across borders in the digital space. Case study 2. Amazon in India. In 2016, India introduced the Equalization Levy, a form of digital tax targeting online advertising services provided by non-resident companies to Indian customers. Due to Amazon's online advertising activities targeting Indian consumers, it consequently faced the challenge of navigating India's tax system and adhering to the Equalization Levy requirements. This highlights how digital taxation measures can impact e-commerce companies operating in emerging markets and the need for these companies to understand and adapt to varied tax regulations across different countries. Case study 3. Facebook in the United Kingdom. In 2020, the United Kingdom introduced the Digital Services Tax, targeting revenues generated by large tech companies like Facebook from digital advertising services. Facebook fell within the scope of the DST due to its revenue generated from online advertising targeted at UK users. Consequently, Facebook had to assess the impact of the digital services tax on its operation and financial reporting, considering the additional tax obligations imposed by the UK government. This demonstrates how digital taxation measures can influence the tax liabilities of tech companies and the importance of compliance with evolving tax laws in various jurisdictions. Now, let us explore some case studies to illustrate various approaches companies have taken to ensure compliance. Case study 1. Google's compliance strategy in Europe. In various European countries, Google faced scrutiny regarding its tax practices. And in response to the changing regulatory environment, Google has adopted a transparent approach to tax compliance. One key strategy employed by Google is to establish transfer pricing policies that align with OECD guidelines to determine the allocation of profits across different jurisdictions. The company has established regional headquarters in countries like Ireland, where corporate tax rates are favorable. By engaging in transfer pricing documentation and working with tax authorities to address any concerns, Google has been able to demonstrate its commitment to complying with local tax regulation while preserving its global tax structure. Case study 2. Amazon experience in India. In response to India's digital services tax on online advertising, Amazon adjusted its pricing strategies for advertisers to account for the additional tax burden. They worked closely with Indian tax authorities to ensure proper reporting and remittance of the tax. Additionally, Amazon invested in building internal tax compliance capabilities in India to ensure the accurate calculation and payment of digital services tax. This shows Amazon's commitment to following Indian tax laws while expanding its business in the country. Case study 3. Facebook approach in Australia. In Australia, the government implemented legislation to tax revenue generated from digital advertising services provided by multinational tech companies. In response, Facebook collaborated with tax authorities to understand the new tax requirements and ensure compliance. Facebook invested in developing tools and systems to accurately track revenue generated from digital advertising in Australia. They integrated these tools with their global reporting system, providing transparency to tax authorities. Additionally, Facebook proactively engaged in dialogue with Australian regulators to address any concerns and ensure alignment with local tax laws. By demonstrating a willingness to cooperate and comply with the new tax regulations, Facebook has maintained a positive relationship with Australian authorities while fulfilling its tax obligations. Now, some key lessons that can be learned from these case studies to guide multinational tech companies in Nigeria in developing effective digital taxation compliance strategies. Proactive engagement with Federal Inland Revenue Service. Companies should proactively engage with FIRS in Nigeria to understand local tax regulation and requirements. By so doing, companies can mitigate compliance risk and demonstrate a commitment to complying with the law. Investment in internal tax compliance capabilities. Companies should invest in developing robust systems and processes for tracking revenue and calculating tax in Nigeria to ensure accurate reporting and remittance of digital taxes. Doing this can enhance their compliance efforts and minimize the risk of non-compliance. Adoption of transparent transfer pricing policies. Companies should adopt transparent transfer pricing policies that align with OECD guidelines to allocate profit across different jurisdictions. By documenting transfer pricing arrangements and engaging in dialogue with the tax authorities, companies can demonstrate their commitment to complying with tax laws while maintaining a global tax structure. Alignment with global reporting infrastructure. Companies should integrate local tax compliance systems with their global reporting infrastructure to ensure consistency and accuracy in reporting revenue and taxes. By doing this, companies can streamline compliance efforts and provide transparency to tax authorities. In conclusion, the case studies from France, India, and the United Kingdom underscore the evolving nature of tax regulations targeting digital services. Lessons from global markets emphasize the need to engage with tax authorities, invest in internal compliance capabilities, and align with global reporting standards. For companies in Nigeria, proactive compliance strategies tailored to local tax laws are essential. By staying informed and implementing robust compliance measures, multinational tech companies can navigate the complexities of digital taxation in Nigeria and maintain competitiveness in the global economy. And there you have it. If you found this video helpful, don't forget to like, subscribe, and hit that notification bell for more insightful content. Also remember to watch our previous videos.